listening to Turning Hard Times into Good Times with your host, Jay Taylor. If you have a question or comment about today's show, Jay would love to hear from you at 1-866-472-5790. That's 1-866-472-5790. You can also send an email to questionsfortaylor@gmail.com. That's questions, the number 4, Taylor@gmail.com. Now, back to our program.
Welcome back to Turning Hard Times to Good Times. I am your host, Jay Taylor, and I'm really pleased to have with me once again James Rickards. He is the author of the best-selling Currency Wars, published in 2011, The Death of Money, published in 2014. He is a portfolio manager at West Shore Group and a partner in Tangent Capital Partners, based in New York. He is also an investment advisor and has held senior positions at Citibank, Long-Term Capital Management, Caxton Associates as well. In 1998, he was the principal negotiator of the rescue of the LTCM by the Federal Reserve. His clients include institutional investors and government directors. He has been interviewed in the Wall Street Journal, has appeared in CNBC, Bloomberg, Fox, NPR, and is an op-ed contributor to the Financial Times, New York Times, and Washington Post. He is an advisor on capital markets to the Office of the Secretary of Defense. Mr. Rickards holds an LLM degree in taxation from the New York School of Law, a JD from the University of Pennsylvania Law School, and an MA in International Economics from SAIS, and is a BA from Johns Hopkins. Many of you have listened to James on this show in the past when we talked to him about two of his other best-selling books, Currency Wars and The Death of Money. But now he's back with still another book, which I'm guessing will be another bestseller. His work is so interesting and so fascinating, but also very important, and I think life-sustaining potentially as we head into a very uncertain future. The name of his new book is The New Case for Gold, and that is what we want to talk to Jim about today. So we're really grateful, Jim. Thanks for being with us once again.
Great to be with you, Jay. Thanks for inviting me.
Always good to talk to you. You know, part of what you do in your new book is to correct some misconceptions about gold and why it is important to hold some in your portfolio. But before we get into the reasons why you think everyone should own some gold, one thing you point out is Lord Keynes never did really call gold a barbaric relic. Rather, what he was saying was that the gold standard of the 1920s was a barbarous relic. Now, you have indicated that you are in agreement with Keynes. Can you talk to us a little bit about the gold standard of the 1920s and why you think Keynes was right in calling it a barbarous relic then?
Sure, Jay. And you're right. About 90% of the book, The New Case for Gold, are sort of positive, affirmative arguments in favor of having physical gold in your portfolio. But about 10% of the book, I had to knock down all these myths. And part of the reason I wrote this is obviously educational. I'm not a gold dealer, but I am an author and a researcher and analyst. And the reason I wrote the book was I not only wanted to kind of inform and hopefully educate people on the reasons to have gold, but I had to shoot down these myths. I was so tired of hearing them because obviously I debate and talk about gold, and people throw these things in your face, and none of them are true. So I kind of took them one by one and knocked them down. So the one you're referring to, how many times have you heard it? Probably 1,000 times.
Yeah.
Maynard Keynes said gold is a barbarous relic. Well, he didn't say that. What he actually said, and I have actually bought a first edition of one of his 1924 books because I wanted to go right to the source. He said the gold exchange standard of the 1920s, which is a particular highly flawed gold standard, was already a barbarous relic. He wasn't talking about gold itself. Mm-hmm. Now, that's important because why was that flawed? Why was Keynes right? First of all, Keynes is probably the most quoted gold basher, but it's not true. In 1914, the UK wanted to go off the gold standard at the beginning of World War I. All of the major combatants, remember, the U.S. was neutral, but all the other combatants, Germany, Italy, France, UK, one by one, they were going off the gold standard, suspending redemptions of gold, because they wanted to hang on to their gold, because they knew they would need it to fight the war. What Keynes said was, no, the UK should stay on the gold standard and stand up and allow redemptions of gold. He said, because then we'll have good credit. Gold is finite, but credit is elastic. We could use our credit to win the war, and that's exactly what happened. J.P. Morgan organized massive loans for the UK and organized no loans for Germany, and it was that financing power from J.P. Morgan in New York that helped them to win the war. So Keynes was an advocate for gold in 1914. come to the end of his life in 1944 at the Bretton Woods Conference. He was one of the principal delegates, in addition to the U.S. delegate Harry Dexter White. At that point, Keynes argued in favor of a kind of world money. He called it the Bancor, B-A-N-C-O-R, which is the theoretical predecessor of today's special drawing right from the IMF. But his Bancor was backed by a basket of hard commodities. It was not a pure gold standard, but it included gold. So he said, let's take a basket of, wheat, corn, steel, gold, silver, and other commodities, and have that back up the currency, and that's how we'll determine the value of the currency. So a modified gold standard. So there he was in 1914, arguing in favor of staying on the gold standard. There he was in 1944, arguing in favor of going back to a modified gold standard. In the middle of his career, in 1925, the conversation, Winston Churchill was the Chancellor of the Exchequer, so, the equivalent of the Secretary of the Treasury. The world was trying to get back to a gold standard, which it had been on prior to 1914. The question was, at what price? What should the price of gold be? And Winston Churchill wanted to go back to the pre-World War I price, the 1914 price, which was approximately $20 an ounce. But Keynes said, no, that would be a mistake, because England had doubled the money supply to fight the war. So he said, if you want to go back to the old parity and you've doubled the money supply, you're going to have to cut the money supply in half to maintain the parity, and that's going to be deflationary and depressionary. Churchill didn't listen to him. They went back at the wrong price. It was deflationary. It contributed to the Great Depression. Gold has had a bad reputation ever since. But Keynes wanted to double the price. Keynes said, no, you should go back around $40 an ounce. So, and that has very significant implications, Jay. If we ever go back to a gold standard or anything like it in the future, they're going to have to get the price right. They don't want to repeat the mistake of 1925. And I've done that math, and that's where I get to $10,000 an ounce. When I say $10,000 an ounce, it's not made up. I didn't pull it out of a hat. I'm not trying to get headlines or scare people. That is the implied non-deflationary price of gold if you want to avoid the blunder of 1925. And it's just a ratio of paper money to gold. It's not that difficult to figure out. So I think we're heading for $10,000 gold. Keynes, interestingly, wanted to stay on the gold standard in 1914, double the price of gold in 1925, and go back to a gold standard in 1944. Keynes understood gold better than most people even today. So he's got a bad rap from the Keynesians. I don't agree with Keynesians, but I do agree with Keynes. The one has nothing to do with the other.
Well, that certainly is. You certainly are curing a misperception there, James, because I have always believed, I guess I didn't look into it deeply enough, that Keynes really had a hatred for gold. But what you're telling me is quite the opposite. In fact, what was important then would have been to keep, if you're going to print money, you've got to see the price of gold increase accordingly, I guess, and that was the message that he was trying to give Churchill.
That's right. This is all covered in the introduction of my book, The New Case for Gold. It's I hope the readers enjoy it. It's all detailed in there.
Well, I think it's very important for people to understand that. Thanks for providing that insight to me, which is new to me. Aside from their homes, most people really have most of their wealth, if not most of it, in stocks and bonds. You have talked about systemic risks of the financial system in the past. But now in your new book, you're talking about cyber attacks and how that could cause wealth to disappear overnight. Talk to us a little bit about the threats of cyber attacks and maybe give us an example.
Well, that's a great question, Jay, and that's why my book is called The New Case for Gold. Because people say, well, Jim, what's new about it? This debate about gold has been going on for decades. And that is true, and I cover all the familiar arguments, pro and con. But there are new 21st century reasons to have gold that have not been debated before, and one of them is the one you just mentioned, which is the threat of cyber financial warfare. Now, right now, as we speak, Vladimir Putin has a 6,000-member cyber brigade operating outside of Moscow. These are not criminal gangs trying to steal your credit card number. These are Russian military and intelligence assets working night and day to invade, destroy, disrupt, erase, and delete digital records. So I bump into, very wealthy individuals and billionaires for that matter, and you say, well, I got stocks, I got bonds, I got this. I say, no, you don't. You have electrons. All of your so-called wealth is in digital form, and Vladimir Putin can erase it in a heartbeat. And, I say things like that, and people roll their eyes and go, oh, that's science fiction, that would never happen. No, it's happening. Just last week, the government of Bangladesh, one of the poorest countries in the world, by the way, announced that $100 million of their reserves disappeared. Now, where did they have it? Was it some rinky-dink bank in Bangladesh? No. Bangladesh deposited the $100 million with the Federal Reserve Bank of New York, arguably the safest, soundest bank in the world, Federal Reserve Bank of New York. $100 million disappeared. If they had had physical gold, they'd still have their $100 million. So this is real. It's happening in real time. It's not just Russia. It's China, North Korea, Syria, Iran. I don't understand how people can sleep at night with digital wealth. People, they tell themselves, they say, I've got stocks, bonds, money market funds, and munis. I say, no, you don't. You have electrons. You have digital title. That digital title can be erased and deleted, or the power grid can go down, or the banks can close, or the exchanges can close. You know, and I say things like the New York Stock Exchange could close. People go, well, that would never happen. Sorry, the New York Stock Exchange was closed for 5 months from July to December 1914. It was closed during Hurricane Sandy. It was closed after 9/11. It closes every weekend. New York Stock Exchange closes all the time. So the point is, you can't count on that. If you have physical gold, that wealth cannot be deleted, cannot be hacked, cannot be erased, cannot be closed, doesn't depend on the power grid. I don't recommend 100%. I'm not saying pull all the money out of the bank and sell all your stocks and buy gold. What I'm saying is allocate 10% of your investable assets to physical gold. Then you'll be able to sleep at night. That wealth will be preserved no matter what happens.
All right. So, in order to protect yourself against this sort of cyber attacks or the electronic wealth, as you call it, physical gold is what you're recommending, and I guess that's really about physical gold and probably other portable assets or other assets also, not just gold, and probably silver would be another one. I guess you're recommending other commodities or maybe diamonds or maybe various things that you might own as a store of value, right?
Yeah, well, I'm not big on diamonds because they're actually not that scarce. I mean, De Beers Monopoly has done a wonderful job of creating a false sense of scarcity, but diamonds are all over the place. They're actually not that scarce. But the other things you mentioned, yes. So I recommend 10% gold, and then people say, well, what do I do with the other 90%? Well, there's a place for land. It can be farmland. It can be, rental properties that produce income. It can be your own estate, but I would have land. My best performing asset the last 5 years is fine art. There are, you have to go out and buy a $100 million Picasso. There are good fine art funds that for $100,000, $200,000, you can buy units, and they take the money. But there's physical fine art behind it. It's not a digital share, in other words. Silver has a place, particularly in if there's social unrest, because people say, well, gee, if I have a 1 ounce gold coin, how am I going to buy groceries with that?
Right.
It's like too much money, which it is. But a 1 ounce silver coin, gold is probably a year's worth of groceries, and silver is probably a week's worth of groceries. You're going to want to buy your groceries a week at a time. So have a monster box of 500 1 ounce American Silver Eagles. Put it in a safe place. That'll be your walking around money in the event of, the power grid that is out. So I would say gold, silver, fine art, land. I have investments in private equity and technological funds, tech funds, kind of venture capital type funds. But see, those are paper contracts. You actually know who the CEO of the fund is, or not even the fund, but the company. I actually invest in private companies. It's a real company. You have title to something. It's in paper. You're not relying on a digital exchange. So that's a diversified portfolio. There's a place for cash. People say, Jim, you're the guy talking about the death of money. Why would you want cash? And the answer is, well, you might not want it forever, but in the short run, it'll give you a lot of optionality, and it's a good deflation hedge. So there is a balanced portfolio you can have, but what they all have in common is they're not vulnerable to, the collapse of the stock market and digital erasure. Yeah, bank account might be, but not, physical assets and land and gold and silver and art and things like that.
All right, so if you own shares in a private equity firm, for example, and they go out and buy art, you have that backing in your shares, so you have some tangible value. And if you know the people you're dealing with, I guess that would be an option. But, I'm thinking in terms of if I go out and buy gold stocks, for example. Correct me if I'm wrong, you're a lawyer, or you have a couple of law degrees. If I own shares, those shares are really not my property, are they? I believe that I am lending those shares to the brokerage firm. Isn't that right?
Well, it depends on your account documentation, but in the first instance, you buy shares. Okay, but I can't remember the last time I saw a physical stock certificate other than private companies. Yeah, I do have physical stock certificates in my vault. So they do send them. But, public companies are all digital. You're relying on exchange, number one. Number two, they're in what's called street names. So you have a confirmation from maybe Merrill Lynch or Goldman Sachs or Morgan Stanley or Charles Schwab or somebody, but the shares aren't in your name. They're in the name of Charles Schwab, DTC. So you're sort of you're one step removed that way. So not only is it digital, but you're one step removed because the broker stands in between. And then most brokerage accounts, not all, but most brokerage accounts allow for what's called hypothecation. So they have permission from you, whether you know it or not, if you got to read the fine print, to lend those shares out to somebody else. Somebody else could fail to deliver. So there's a whole string of things that could go wrong. I'm not saying don't own any stocks. I'm just saying understand the risks. And if you're going to take that risk, make sure you've got some physical gold over here to protect you. It's kind of like fire insurance, right? You don't want your house to burn down, heaven forbid. But if it does burn down, you're glad you have the fire insurance. So you don't want the stock market to collapse. But if it does, you'll be happy you have some gold.
Jim, if I had shares in a private equity fund, and that private equity fund might actually hold the share certificates and take them out of street name, would that be generally the way they operate?
Sure, that's correct, because they're not those companies by definition they're private. They're not publicly traded. They're not listed on stock exchanges. Those shares are paper contracts. And by the way, Jay, some of the companies I own, I don't even own them through a fund. I actually buy actual shares in the company. It's private. You have to know the sponsor and the CEO, and they're not traded on exchanges. And these deals tend to be word of mouth or passed around among certain individuals. But there you actually you might get a share certificate, or you might get what's called a cap table in a written partnership agreement. But what's interesting is that it's a paper contract. If you ever needed to enforce it, you could walk down to the courthouse and assert your rights. But you're not relying on the digital network that Vladimir Putin can erase. I'm not saying the power grid will go down forever. I'm just saying that if they erase it, how do you reestablish your title? Whereas with the private companies I own, I've got my title and my vote. I've got a contract. I can prove it.
All right. So I think also another misconception that people have that I don't know if you mention in your book. You probably don't in this case, but I just want to hear what you have to say about it. Most people assume that if their salaries are put into a bank, it's their money. In fact, I think it's very much like you just described shares of stock that are in street name. The banks actually have received an unsecured loan from me if I put my money in the bank. That's my understanding. Is that yours?
Well, that's correct. It's always been true, by the way. That's not a new...
Nothing new.
Right. If I have money in the bank, whether I put it there or somebody pays me or get an incoming, whatever it is, if I have money in the bank, I don't actually have money. That's not actually money. That is an unsecured liability of an occasionally insolvent financial institution. These banks were all insolvent in 2008. So it's basically an IOU from the bank. So what can go wrong? Well, the bank could fail, for one thing, or they could be shut down. And it's funny, Jay, when you say things like this, people always say, oh, that would never happen. Sorry. In 1933, the president, by executive order, closed every bank in America. There was no act of Congress. There was no warning. The president just went on the radio and, by executive order, shut every bank in America. And that could happen today. Those laws are still on the books. The law that Franklin Roosevelt used in 1933 to close the banks was called the Trading with the Enemy Act of 1917. I don't know who the enemy was in 1933, probably the American people, but he used the... Well, I got news for you. The Trading with the Enemy Act in 1917 is still the law of the United States.
Yes.
It has been updated. There's something called the International Emergency Economic Powers Act of 1977, signed by President Jimmy Carter, that gives the President of the United States dictatorial powers to freeze and seize bank accounts and other financial assets. So this is not science fiction. I happen to be a lawyer. I read these things. I do a lot of work for the national security community. I'm an expert in threat finance. This is how I spend a great deal of my time. And so the president could shut the banks with a phone call, just one phone call, just like that. So no, you don't have. If you have money in the bank, you don't have money. You have an IOU from an institution that may or may not pay you. People say, well, I have deposit insurance. Fine. What if the deposit insurance company goes bankrupt? Or what if your amount is in excess of the deposit insurance? Look what happened in Cyprus. Look what happened in Greece. Now this bail-in policy, which is even worse, which is, okay, the bank becomes insolvent. Now, not only are we not going to give you your money, we're going to take it and turn it into stock and send you a stock certificate. So, welcome to the Stockholders Club, right?
Yeah.
That's a bail-in where they convert your money into equity to prop up the bank. Mm-hmm. That is now official policy of the G20, including the United States. again, not made up. Look at the G20 meeting in Brisbane, Australia, November 2014. They had working papers. Enough of a geek that I actually read all these things. And one of the working papers was officially certifying that bail-ins, conversion of deposits into equities, is the rule of law in all the G20 members, including the United States. So it's all there. I don't know how much more warning. I don't know what else I can say or what else I can do. I'm doing the best I can, but I'm not saying sell everything and buy 100% gold. I am recommending 10% of your investable assets in gold. It's all, by the way, Jay, it's all in my book, A New Case for Gold. And the good thing about the book is people don't have to read all the rule books of the exchanges. You don't have to read Dodd-Frank, G20, final communiques. I do all that. It's all in the book, and it's there in plain English, and I hope people enjoy it.
1933, you're mentioning executive order by President Roosevelt closing the banks. At that time, he also made it illegal to own gold. I think the penalty was $10,000, which was a heck of a lot of money in those days, and 10 years in jail. At least that's my understanding. That was what was on the books at that time. Is there a chance something like that could happen again, in which case owning gold may not be such a great idea? Although even then, I guess you were given dollars in exchange for the gold.
Well, that's a very good point. Now, what President Roosevelt did, he confiscated all the gold by executive order, but he did pay people for it. And that's required under the Fifth Amendment to the Constitution. The government cannot take private property without giving compensation. But the trick was they paid everybody $20 an ounce, which was the price at the time. But the president knew that he was going to raise the price to $35 an ounce. This is like insider trading. So he bought up all the gold at $20 an ounce. They then raised the price to $35 an ounce in stages over the next 7 or 8 months. And what the president did, he captured that $15 profit, which, by the way, is a 75% profit, right? Interesting. 1929 to 1933 was the longest period of sustained deflation in American history, and yet the price of gold went up 75%, from $20 an ounce to $35 an ounce. Interesting. That proves that gold goes up in deflation and inflation. But anyway, coming back to the gold story, so the president knew what he was going to do. He bought it at $20. That's how he got around the Fifth Amendment. He then raised the price to $35, thereby depriving American citizens of their 75% profit. And by the way, that profit, the difference between the $20 and the $35, that profit was put into the Treasury and became the Exchange Stabilization Fund. Still exists to this day. That's how the Exchange Stabilization Fund was created, with that profit. It still exists today. It's an unaccountable slush fund for use by the Treasury for manipulation in foreign exchange markets. Bob Rubin, Secretary of the Treasury in 1994, used it to bail out Mexico. The White House, Clinton White House, went to Congress and asked for a bailout bill to bail out Mexico. Congress said, "Are you crazy? We're not doing that." So what happened? Rubin took the Exchange Stabilization Fund and bailed out Mexico. He said, "The heck with Congress, we'll work around you." That slush fund is still there, but ironically, it came from the profits of insider trading by buying gold at $25 and then raising the price to $35. So this is our government at work. So technically, they got around the Fifth Amendment. The problem today is I don't think there's as much trust in government. I think if the government tried it, they would still have to compensate people at some level. But probably by the time that happened, the gold would be at $10,000 an ounce or more. So the government actually couldn't afford it. They'd be paying us $10,000 an ounce for our gold unless they want to suspend the Constitution. I mean, you can always hypothesize a worst case. Nothing is risk-free, but
sure.
I actually don't see it happening that way because by the time the government wakes up, gold's going to be at $10,000 an ounce, and they actually won't be able to afford to buy our gold.
Well, it's the Exchange Stabilization Fund, also called the Plunge Protection Team, I guess, by the Wall Street Journal. I'm thinking here, Jim, that what Roosevelt did was what Keynes suggested Churchill should have done, right? That is to increase the price of gold. Really, it was a way of inflating the money supply at that time, wasn't it?
Well, that's exactly right. And Keynes visited the White House and met with President Roosevelt between 1925 and 1933. So you're right. Roosevelt did what Keynes recommended to Churchill. Churchill didn't do it. He blundered. Roosevelt did it. He got it right. By the way, 1933 to 1934, in the middle of the Great Depression, was one of the greatest stock market rallies in history. Mm-hmm. The reason Roosevelt raised the price, he wasn't trying to do any favors for gold miners or people who had gold. Mm-hmm. He was trying to basically devalue the dollar and inflate the markets. Because his thought was, hey, I want gold to go up, not because of gold, because I want everything else to go up. And it worked. cotton, steel, corn, wheat, all these commodities went up. The stock market went up. He reflated the economy by devaluing the dollar, by raising the price of gold. It was all a massive manipulation, but it worked. It was what Keynes recommended. The only difference between Churchill and Roosevelt is Roosevelt stole the profits. Instead of, at least when Keynes was talking to Churchill, individual citizens or subjects of the UK would have had the profits. What Roosevelt did, he captured the profits for the U.S. government and deprived the citizens.
Jim, I just saw something on the internet recently, very recently, I believe, in which you did an interview with somebody, and you talked about the secret Shanghai Accord or something like that. I think it was the G20 meeting that when they last met.
Right.
I'm just thinking of that now as you're talking about devaluing the dollar. We've seen some dollar weakness. We've seen some gold increase here in the new year. Do you think that's something that we might be looking at in terms of the currency wars you've talked a lot about?
Sure. This meeting, we know about the meeting. We know who was there now. What was said behind closed doors. You have to use an inferential method. You have to look at actual behavior by the European Central Bank on March 10th, the Bank of Japan on March 15th, and the Federal Reserve on March 16th. So you have to look at the behavior to kind of work backwards to what was actually done. But this meeting took place on February 26th this year in Shanghai, and it involved the G20 finance ministers and central banks. So, who was there? Janet Yellen, Mario Draghi, Jack Lew, our Secretary of the Treasury, Christine Lagarde, the head of the People's Bank of China, all the major players were there. And what they did was very clear. It's really complicated, but what they were trying to do was to devalue the Chinese yuan without anybody noticing.
Mm-hmm.
But what happened on August 10th, 2015 was China did a sharp devaluation of the yuan to bail out their own economy, but it almost destroyed the U.S. stock market. I mean, where were you on August 31st, 2015?
Mm-hmm.
You might have been on vacation, might have been taking your kids back to college, but we were staring into the abyss. The stock market was completely collapsing in response to this Chinese devaluation. Now, that's when the Fed backed off their September rate hike, and then the market came back because it was more easy money, et cetera. So now, flash forward to February 2016, China's still in desperate straits. They still have to devalue, but everyone's concerned that if they do, you're going to shock the stock market and take the whole system down with you. So what did they do instead? So the Bank of Japan tightened, the European Central Bank tightened, and the Fed eased.
Yeah.
And what happened was everybody's looking at the China-U.S. dollar cross rate. It's about 6.5 to 1. So everyone's looking at that cross rate, right? And that didn't change.
Oh.
China got the ease and the U.S. got the ease. But over here, it's like a magician. I want to pull a trick. I make you look over there so you don't see me pull the trick. The yen got stronger and the euro got stronger. Well, China has a stronger trading relationship with Japan and Europe combined than it does with the United States.
Uh-huh.
So they got to devalue against the yen and the euro, but not because the yuan went down, but because the yen and the euro went up. It's just a cross rate. And meanwhile, they eased the dollar, so the yuan-dollar cross rate was unchanged. So everyone thinks that China's pegged to the dollar, which they are, but they both eased, and the euro and the yen went up, and so China got the benefit of ease without doing anything official, and nobody noticed.
Wow.
It was a nice finesse. It was like a three-cushion bank shot in pool. They sank the ball, but none of this stuff is sustainable. These are all just pulling rabbits out of a hat.
Yeah.
See, the problem, Jay, when you're trying to devalue and you're not on a gold standard, what is it you're devaluing against? It can only be another currency. That's what the currency wars are all about.
Right.
Roosevelt, I mean, he confiscated the gold, but we were technically on a gold standard in 1933. So all he had to do was devalue the dollar against gold. His trick was to steal all the gold before they did it. But it was still a gold standard, right?
Yeah.
But today, there is no gold standard, so how do you devalue against gold officially? Well, you can't. So you have to devalue against other currencies, so you get into all these currency manipulations. But meanwhile, citizens can go on a personal gold standard. I always tell people, don't wait for governments to give you a gold standard.
Yeah.
Go on a personal gold standard by putting 10% of your assets in physical gold. And I talk about this in my book, The New Case for Gold. It's available on Amazon. It'll be in bookstores Tuesday. But I explain all this. So you can go on a personal gold standard and protect your wealth. You don't worry about the central banks preserving your wealth for you. Do it yourself.
Indeed, people that have owned gold in almost all currencies over the last 2, 3, 4 years or so have done very well relative to their currencies, with the exception of the dollar, perhaps. So, and now the dollar is getting weaker because, as you say, it's like a magician, sleight of hand operation going on here now with to lessen the value of the yuan. So for the sake of China, very interesting stuff, Jim. There's so much to talk to you, always so much to talk to you about. I have to ask you about your impression of what's going on with our alleged adversaries, China and Russia. We see, you mentioned Putin and the games he's playing in cyberspace, but it seems to me, and correct me if you think this isn't true, but it seems to me from what I'm reading, China has been importing for the last quite a few years lots and lots of Western gold. It's the largest gold producer supposedly in the world. And we're seeing that Russia is also increasing its gold holdings very dramatically. And I'm reading reports that some of the oil that Russia has sold to China has been paid for in gold to Russia. I don't know if that is in sync with your understanding or not, but if it is, what do you think the Russians and Chinese have up their sleeves, if anything?
Well, part of it's economic and part of it's geostrategic. And you're absolutely right, Jay. I mean, the evidence is clear. This is not speculation. China has acquired officially somewhere around 4,000 or 5,000 tons of gold in the last 7 or 8 years. Now, no one knows the exact number because they lie about it. Officially, they say they have 1,700 tons of gold, but we know that they have closer to 4,000 or 5,000 tons. How do we know that? Well, we do have reliable export data from Hong Kong. China lies about the numbers, but Hong Kong doesn't. Hong Kong's relatively transparent. So we know exports coming from Hong Kong to China. We know that number. We know from geological surveys how much China is producing, about 450 tons a year. So if you combine the Hong Kong exports and the indigenous gold production, you come up with a figure of about 1,100 tons a year. But they've been doing this for 7 years. So you're looking at upwards of 9,000 to 10,000 tons of gold have come into China. Just to put that in perspective, there are only 35,000 tons of official gold in the whole world.
Mm-hmm.
All the gold owned by all the central banks, the Treasury, Fort Knox, Bank of England, IMF, all of it together is about 35,000 tons. So here's China has scooped up 10,000 tons, equivalent to a third, slightly less than a third of all the official gold in the world in the last 7 years. Now, what we're not sure of, although I have pretty good information on this also, how much of that, let's call it 10,000 tons, how much of that went to private consumption in China, how much of it went to official channels. I just returned from Switzerland. I met with the head of the world's largest gold refinery. He supplies the gold to China. They're one of his customers. He sends them 10 tons a week. He says they want 20 tons. I won't give it to them because I have trouble finding it myself, and I have other customers I have to fill their orders. So he's actually back-ordered on gold. But he sends China about 10 tons of gold a week. So he knows who the sellers are. He knows who the buyers are. He estimates that the split is about maybe 70% private consumption, 30% government. So if you take 10,000 tons of imports and mining production, apply the 30% factor, that means 3,000 tons has gone to the government. Perhaps a little bit more, it's an estimate. But the problem is China is trying to get to 8,000 tons because that's how much the U.S. has. They want to match the U.S. so that when the system needs to be rebooted, when the collapse comes and the major powers, Jay, think of it as a poker game. 5 or 6 guys are going to sit around the table and play poker. What do you want? You want a big pile of chips, right? So the U.S. has an 8,000-ton pile of chips. Europe has 10,000 tons. The IMF has 2,000 tons. China wants to at least match the U.S. They want the 8,000 tons. So they're still out to buy it. So we know that. So what they're trying to do, there's a lot of speculation that they're trying to make the yuan a global reserve currency and have it backed by gold. I think that's nonsense. The yuan is nowhere near ready to be a global reserve currency. If there's a global reserve currency that's going to replace the dollar, it will not be the yuan, it will not be the ruble, because they're not ready for that. They don't have bond markets, they don't have dealers and repos and futures and options. They don't have all the stuff they need, rule of law. They don't have any of that. It'll be the SDR, it'll be the special drawing right. But China's ready to play in that arena. But what China is doing is trying to hedge their treasury position. China has $2 trillion of U.S.-denominated debt, most of it U.S. treasuries and government securities. China actually wants a strong dollar because if you had $2 trillion worth of dollar-denominated stuff, you'd want a strong dollar too.
Sure.
But they don't trust the United States, and they shouldn't. They know that the way the United States wiggles out of its debts is through inflation. So you say, well, why don't you just dump the treasuries? Well, you can't because the market's not that big. I mean, the treasury market is the deepest, most liquid market in the world, but it's not that deep and it's not that liquid. You can't unload $2 trillion in treasuries. Cannot be done. So they're stuck with the treasuries. They're worried about inflation. So what do? They're buying gold. Now, if by the thousands of tons, as I described. Now, if the dollar is sound and there's no inflation, the gold's not going to do very much, and they'll keep the wealth that they've accumulated. But if the U.S. inflates the dollar, which we will, and the value of the treasury starts to evaporate, the value of the gold will skyrocket. So a strong dollar, they win on the treasuries. A weak dollar, they win on the gold. So you're just setting up a hedge position. So what I say to investors is, hey, if it's good enough for the Chinese, it's good enough for me. What are you waiting for?
Right. And the book is The New Case for Gold. Everybody should go out and buy it. It will be in the bookstores, and you can buy it on Amazon and elsewhere on Tuesday, I believe, Jim, you said.
Well, in bookstores on Tuesday, but you can buy it on Amazon right now.
Right now. You can order it right now. Excellent. Right. Very good. Before I let you go, I want to ask you about something else. I just saw, according to a French radio report, it was quoting U.S. Secretary of Treasury Liu, as warning Congress not talk tough or enact any kind of legislation, trading legislation against the Iranians. I'm wondering, do you have any thoughts on that? Have you seen that report that he's suggesting that, because the presidential candidates, of course, are talking, the Republicans at least are talking tough about how terrible Obama was with what he did and with Iran, and how we should really, start getting tough with them again. And according to this, Jack Lew is saying, don't do that, because he's even talking about it hurting the dollar if we decided to do that. Does that make any sense to you?
Well, I haven't seen that particular report, but it comes as no surprise because the White House has said similar things. And you're right, Jay. We were in a financial war with Iran, a backroom cyber financial war with Iran. We kicked them out of the payment system. We didn't let them get dollars. We froze their accounts. People were smuggling dollars into Iran, coming in from Iraq. There was a black market. The currency collapsed. The central bank had to raise interest rates to help keep money in the bank. They had borderline hyperinflation. We were very close to regime change in Iran without firing a shot, just using financial weapons. In December 2013, President Obama declared a détente, or a truce. We started to relieve the sanctions, and we've been relieving them ever since, to the point now that Iran is getting billions of dollars, over $100 billion of frozen assets. Now, it would be one thing if Iran was on their best behavior, if they had stopped their uranium enrichment with centrifuges, shut down the nuclear power plants, stopped their ballistic missile tests. It would be one thing if they were on their best behavior. It's like, hey, welcome back to the Club of Nations. But they're not. We've given them all the breaks, but they have turned their back. They continue to run the centrifuges, enrich uranium, work on weapons designs. They're buying advanced designs from the North Koreans, test ballistic missiles. They're well on their way to having a nuclear intercontinental ballistic missile that can hit New York. So why we've let them do this, I have no idea. I think it's an enormous blunder. I think it'll come back to bite us. But the Congress is saying, okay, we're fed up. Why should we give Iran economic relief if they're not willing to behave in terms of their weapons system? So that's why there's this move in Congress to reimpose the sanctions. And Lew is saying don't do it, but he's just working on orders from the White House. It defies comprehension. It baffles me as to why the White House is so pro-Iranian.
I'm just wondering if there's something more involving the Russians and the Chinese, because they seem to be closer to Iran than we are. I mean, could there be something in terms of competition against the dollar or something like that?
Sure. I mean, that's going on. First of all, Iran has already announced that they will no longer sell oil for dollars. If you want to buy Iranian oil, you have to use euros. You can use euros, or maybe they'll take Japanese yen, maybe they'll take gold, but they're not taking dollars. That's already happened. We talked a lot, Jay, about China and Russia acquiring gold. Iran is acquiring gold also. A lot. It's smuggled in from Turkey. It's smuggled in from Dubai. Again, they're non-transparent. We don't know the exact number, but they don't have that much gold gold mining in Iran, unlike China, which does. So they have to import it all. It's coming in by the ton from Turkey and Dubai and elsewhere, India and other places, other sources. So I call it the axis of gold. Russia, China, and Iran, three geopolitical adversaries of the United States. I'm not saying they're going to have a new global reserve currency tomorrow. I am saying they're getting ready for that, and that's going to be the end of the dollar, or at least loss of confidence in the dollar, which is hyperinflationary. just one more reason to get some gold yourself.
Yeah, indeed. It certainly seems the wise thing to do because these countries are hedging their bets against the dollar that is likely to decline. I mean, I can't help but recall a comment that Kyle Bass, a hedge fund manager, made a couple of years back in which he said he talked to a senior Treasury official and he talked about the dollar being trashed at some point in time. And that I would imagine in order to try to overcome this deflation that is so rampant, this sort of debt trap that we've gotten ourselves into with all this enormous amounts of debt, that probably what Roosevelt did, but in spades, perhaps, I think is what you're suggesting. And Jim, do you see if we go to an SDR kind of a arrangement globally, as you suggest, would be the only sort of alternative to the dollar? Do you think that would have some component of gold in it, perhaps?
Well, it could theoretically. I mean, actually, world money is not a horrible idea if it's sound. Mm-hmm. And the way to make it sound, of course, is to back it with gold. By the way, when the SDR was created in 1969, people think this is something new or made up or invented. It's not. These things have been around since 1969. By the way, there were several $100 billion worth issued in 2009, August, September 2009, during the depths of the last financial crisis. The IMF issued several $100 billion equivalent of SDRs. I might have been the only one outside the IMF who noticed, but they did. They do just. But the original SDR was backed by gold. It was. Now, they got rid of that pretty quickly. They got rid of that by the early 1970s, and the current SDR is not backed by anything. But originally, it was a gold-backed SDR, and, of course, the predecessor was Maynard Keynes' Bancor, which was backed by gold and other commodities, so that was the theoretical predecessor. So there's history for that, but I think I don't think that's likely. It could happen. It wouldn't necessarily be a bad thing if it were done correctly, although, as I say, the price of gold would have to be over $10,000 an ounce to avoid deflation. But I think the convenience of the SDR is that, the IMF is completely unaccountable, unelected. No one even knows who they are. I mean, I know who they are, but most people don't. So they could create inflation, and nobody would know where it was coming from. In other words, you'd see the inflation. It would show up at the gas pump in the grocery store. People would call their congressman, and they'd yell, and they'd be yelling at the Fed and all that. And everyone would say, hey, it's not us. It's not the Fed. The Fed would say, it's not us. It's those crazy people over there at the IMF. And who even knows where they are? I mean, they're in the West End of Washington. But my point being, who's on the governing board of the IMF?
No one knows.
Well, I do, but everyday citizens don't know.
No, everyday citizens.
But the 24 member nations, well, the heads of those nations, you have kings, dictators, communists. Yeah, there are some democratically elected leaders like Germany and the U.S., but you got a lot of kings, dictators, and communists, and the IMF itself is unelected, unaccountable. So they could produce the inflation by printing SDRs, and nobody would even know where it's coming from, and nobody would be able to stop them. So that's the plan.
All right, and that's just another reason to own gold, and another reason, folks, to go out and buy a copy of The New Case for Gold by Jim Rickards. Thank you so much, Jim, for being with us again. It's always a delight to hear from you. Thank you, and wish you best of luck in your what will, I'm sure, be another bestseller. Thank you so much for being with us today.
Thank you, Jay.